To understand how physical objects move, scientists often start by imagining a world without friction, a perfect vacuum, a frictionless plane. Modern finance theory uses a similar starting point, the efficient market hypothesis. This theory envisions a market that adapts instantly. When a company releases an earnings report or a central bank adjusts an interest rate, the price of every related asset adjusts to reflect that new public information immediately. Formulated in the 1960s by Eugene Fama, this concept provided the baseline for understanding how assets are priced. It assumes all investors process data correctly and form unbiased expectations without delay. However, a market is not a mathematical vacuum. Pure theory often ignores the unavoidable friction of human reality, the time, capital, and cognitive effort required to actually find and process that data. While the efficient market hypothesis provides the framework, it leaves us with a difficult question. If information is never free to obtain, can prices ever be truly perfect? This conflict between perfect theory and messy reality was formalized in 1980 by Sanford Grossman and Joseph Stiglitz. They identified a paradox at the center of how prices form. Active investors spend massive amounts of capital and time gathering data and projecting cash flows. They incur real costs to figure out what a company is worth. This creates a problem. If market prices already reflected all available information perfectly, these investors would generate zero mathematical incentive to pay for that research. Without researchers actively digging for information, no one is doing the work required to push prices toward their correct values. The mechanism of price discovery collapses. To function, the system must offer a reward. The market must contain exploitable mispricings, pockets of incorrect valuation, so active arbitrageurs can cover their costs and make a profit. Modern financial exchanges are not frictionless machines. They are efficiently inefficient ecosystems, where price discovery is a paid service, and temporary inefficiency is the currency that pays for it. To locate where these mispricings hide, we need to map the structural model of market efficiency. The foundation is fundamental value. This is the bedrock metric derived by calculating a company's expected future cash flows and applying a discount rate. Next is investor behavior. This covers the cognitive errors, waves of sentiment, and forced selling that pull pricing away from the fundamental baseline. The third pillar is arbitrage costs. Identifying an error is free, but correcting it is expensive. Trading fees, taxes, and the cost of financing capital create a toll to enter any trade. This chart shows the relationship between these pillars. The stable line is the fundamental value. The volatile line is the actual market price, constantly pulled off-center by investor behavior. Economist Fisher Black defined an efficient market loosely. He suggested that as long as the price is between half and twice the asset's true value, the market is performing its job. We can visualize this margin as arbitrage cost bands. These boundaries form a wide channel where the asset's price is allowed to drift. An actionable arbitrage opportunity only triggers when the price breaks outside these bands. Only then is the gap large enough to cover trading friction and guarantee a profit. Inside those bands, mispricings persist. The market ignores them because the real-world cost to correct them exceeds the potential reward. Paul Samuelson formalized this in his famous dictum. He stated that the stock market shows micro-efficiency, where individual stocks are priced accurately relative to each other, but macro-inefficiency, where the overall market can stray from fundamental reality. We can test this by examining empirical data tracking tens of thousands of publicly traded companies over the last century. This graph maps a study by Hendrik Bessenbender. Between 1926 and 2024, 59% of all U.S. public stocks earned a return lower than one-month Treasury bills. A majority of stocks ended up destroying wealth for their investors. The math on the opposite end is extreme. Just 2% of listed stocks generated over 90% of the total aggregate wealth created over that entire century. A second study shifts the focus from stock returns to the underlying fundamentals. It utilized a metric called remaining lifetime earnings to price. It calculates the present value of all the future earnings a company will ever produce and compares it to its initial stock price. The results are stark. 71.8% of surviving firms and 94.7% of delisted firms fail to produce enough lifetime earnings to justify their initial public price. Long-term market efficiency is deeply asymmetrical. The aggregate pricing of the market relies entirely on a tiny minority of statistical outliers to justify total valuation. Classical finance once assumed that demand curves for stocks were flat. In that model, you could buy or sell massive volumes without altering the price, as long as you had no new information. Modern research shows that the demand curve actually slopes downward. When a large group of investors tries to buy a stock at the same time, the price rises mechanically. The identity of the buyer dictates the price. This matters because the identity of the buyer has shifted. Between 2006 and 2025, $3.2 trillion flowed out of actively managed U.S. mutual funds. That same amount moved directly into passive index funds and ETFs over the same period. Passive index funds operate programmatically. When a stock is added to a major index, these funds are required to purchase shares immediately. They execute these trades without any fundamental analysis. By skipping the costly research process, passive indexers effectively free-ride on the price discovery work performed by the remaining active investors. As capital shifts towards passive vehicles, the market relies on a shrinking pool of analysts to absorb these programmatic waves of buying and selling. Active managers are often criticized for underperforming passive index funds after fees, leading many to assume they lack skill. But the pre-fee data tells a different story. Between 1976 and 2024, the median active manager generated 35 basis points of excess return over their benchmark. They have the skill to find mispriced assets. The fees that erase those gains are the toll required to cross the arbitrage cost bands. It is the real-world cost of doing the research and executing the trades. In exchange for this toll, active managers provide two essential public goods. They provide the liquidity that allows capital to move and the valuation work that forces asset prices back toward reality. The active manager's struggle to beat the market is the friction required to keep the broader market functioning for everyone else. The passive index fund and the active arbitreur exist in a state of necessary tension. One provides scalable capital, and the other executes the critical labor of discovery. If the market became entirely passive, there would be no independent analysis of cash flows. Prices would detach from economic reality, floating solely on algorithmic inflows. The system survives through this tension. It is a fragile equilibrium built on the conflict between those who free-ride on prices and those who are paid to correct them. Market inefficiency is a requirement for price accuracy. Without these exploitable DApps, the entire mechanism of discovery would fail.